Hello, everybody. Welcome to the Candlestick Forum. Tonight we've got Gil Morales and Dr. Chris Catcher to go over their technical analysis of buying gap ups. So they're going to do the first part of the session showing what they've come up with as far as gap ups, and then we'll follow behind it with candlesticks of what goes on there. So without any further delay, I'll let Gil take over and let you guys give us some good information. Welcome to the Candlestick Forum.
Hey, thanks for having us, Stephen. We're very pleased to be here and excited to be part of this, Gap Up webinar series. That we're doing today a couple of back-to-back webinars on Gap Up moves using our traditional boring stick charts, as I call them, and Stephen will come on later and talk about gap ups with candlestick charts. Anyways, I've got with me my partner and business associate and good friend, Dr. Chris Catcher. Are you there, Chris?
I certainly am.
Chris actually will be, the way we're going to do this is I'm going to be making the presentation, and then what we're going to do is just to add another dimension to this, Chris will be available on the general chat if you want to ask questions. So he'll be working the chat and answering questions for you as we go along, and I'll be doing the presentation. So what I want to talk about today is what we call Bible gap up moves in leading stocks, and essentially this is the idea of using gap ups as strong buy signals in leading stocks. And I'm sure everybody can see my screen very nicely here. A lot of work putting this together. But just a quick disclaimer here that the information contained here is not to be construed as an offer to sell or the solicitation of an offer to buy any securities, and the information set forth has been obtained from sources we believe to be reliable, but then it cannot be guaranteed as to their accuracy or completeness. And you can probably read the rest. The bottom line here is that we're not making any recommendations. We're just going to be talking about a particular trading technique, and any stocks that we discuss in the presentation are there for illustrative purposes only. Okay, so I just want to make that one clear to everybody. Anyways, moving right along. When it comes to Bible gap ups, everybody sees a move in a Bible gap up, or actually in a gap up move. Let's not add yet the Bible adjective there. We'll just call it a gap up. When everybody sees a gap up move like you see in this chart right here, the first thought that probably goes through most people's minds is, who would be crazy enough to buy this way up here? Because it looks like it's way up there, and it looks like for the most part the move is over. You can see this stock has been in an uptrend for a period of time. It's formed a couple of consolidations and it's breaking out, but it's just so far up there. How do you buy this thing? And isn't most of the move over with? And I think most people would think that upon first glance of this chart. I know I would, or I have in the past, before I began to study these amazing moves in stocks and these amazing buy signals that turn out to be some of the most profitable moves you'll ever run across, because the answer to the question is, who would be crazy enough to buy that kind of a gap up? This is really what you're looking at on the previous chart. We stopped it right here, right at the 33 level, this bar right here, and we would say we would buy this stock. You can see here this Bible gap up, a huge move on huge volume, set off a move in Crocs back in 2007. That was an extremely profitable move. The stock more than doubled from this point and did it relatively quickly, topping out in October of 2007. But you can see that once you get up to the 48 level, the move and this breakout on the gap up doesn't look as big as it did when you were back here. So, it's all a matter of perception, and in this case, this launched a very strong move. So we find that these types of gap ups, when they are buyable, and we'll get to exactly how you determine why and how they are buyable, but they tend to work mainly because what you're seeing is a technical phenomenon that essentially the argument over the stock has been won decisively by the buyers. Buyers have come in and they're buying the stock in huge volume, and there are really no sellers standing in their way. And so who's winning that argument? Clearly the buyers are. And the power or decisiveness with which this argument is won is characterized by sharp upside price movement accompanied by a significant increase in trading volume. In fact, it's very easy to eyeball this sort of volume. It's just a massive volume spike, as you saw in the previous chart. And this is essentially the signature of a Bible gap up. It's just a big price move on massive volume. And we would say also this same tremendous buying volume is a clear sign of huge institutional buying being done with conviction. In other words, institutions buy stocks mostly on the basis of some sort of valuation analysis, one way or another, either GARP or just pure value, whatever. But they see something of value in the price such that they're willing to gap the thing up and send it up, 10, 15% sometimes on huge volume. And they're doing so with conviction because the volume is there. Now, I think the fourth and probably the most important reason why Bible gap-ups work is the fact that nobody believes him. I mean, what the first chart pretty much showed, who would be crazy enough to buy one of these? And I think that's what most people think. So I think these are really aided by a unique contrarian aspect in that most investors just don't believe the gap, and they're almost always afraid to buy it because they think it's just too high. So, in my view, some of these Bible gap-ups, if you're not buying them, you are high because you're missing a big opportunity. So it's not the stock that's high, but you're high. But in any case, the bottom line is, to use a nice visual here, huge volume gap-ups are really the biggest footprints of institutional investors. And for those of you who've never seen what the footprints of institutional investors look like, it's a nice picture. They don't wear shoes, so in case you were wondering, a lot like the guy who's right there. He's probably a smaller institutional investor, but you can see pretty much the fashion is to be barefoot. But anyways, that's basically what big gap-ups are. There's big institutions coming in, buying stock up, hand over fist, and taking whatever's offered and gapping it up. So let's look at what the characteristics of Bible gap-ups are. So we showed you, how disbelievable they are and why they work, but exactly how do you identify one? And essentially what we're looking for are Bible gap-up moves in stocks that are essentially fundamentally strong and sound leading stocks. They'll generally have strong return on equity, strong earnings growth, sometimes accelerating, and sometimes even the gap-up itself is caused by a news event, for example, an earnings announcement where you see a massive increase in the earnings growth of the company or the sales growth or both. And the company also raising their prospects. And so this kind of news will impact a Bible gap up. So there is always a strong fundamental reason for these sorts of gap ups to occur. And so they do occur in the most fundamentally strong and sound leading stocks. And that's where you want to focus looking for these. You don't want to get bogged down in gap ups that are occurring, say, in stocks, like a biotech that's losing money and maybe there's some test trial for their drug and there's some short-term news there, but there's really nothing behind it that's fundamental. Sometimes that might be a little iffy. So you're basically looking for those solid companies, like an Apple back in the day. Apple's probably topped now, but back in the day there was a couple of big gap ups in Apple that occurred at the beginning of its big run back in 2004. So those are the types of stocks you're looking for. And you could probably just go to the Investors Business Daily newspaper and pull out the IBD 50 or the 8585 index, which are lists of stocks. And
H13 price
you
crossing
could be
over
looking for
8
gap
moving
ups in
average.
those stocks when they do occur. The second characteristic of a Bible gap up is that the move must be at least 0.7 times or 3/4 of the stock's 40-day average true range. So if the 40-day average range, for example, is 4 points, then the move must be at least 3 points. And I would say, if you want to quantify it, this is really, the characteristic that we find from a statistical point of view. But the reality is you can pretty much eyeball these things when they occur. And you look at that first example that we showed, the Crocs, you can pretty much eyeball that that's a significant gap-up move, and it's probably quite a bit more than 0.75 times the stock's 40-day average true range. The third characteristic is, and I think probably one of the most important, if not the most important characteristic, is that it must occur on volume that is at least 1.5 times or 150% above the 50-day moving average of daily trading volume. So if a stock trades 1 million shares a day, you would want to see it trading about 2.5 million or higher. So the volume is really key, and as we showed earlier, it's really the footprint of the institutions coming in and buying with conviction. Now, Bible gap-ups should not occur in a downtrend. They should occur in uptrends or within and out of constructive consolidations, okay? If you have a stock, and you'll see this happen, stocks that are getting beaten down and have been in long-term downtrends, every once in a while there's news. I'll give you an example. Research in Motion, say over the last year or so, there have been rumors of it being bought out while it's been a complete downtrend. A deleterious downtrend too, I might add, because it went down to single digits. But all the way down, you'd have a rumor that Microsoft is going to buy them out, and so you get a gap-up move, but it's occurring within an overall downtrend, and those are the kind of gap-ups that you don't want to be getting involved with. Now, for a Bible gap-up to work, it will establish an intraday low. Okay, once you have the gap-up move, you have an intraday low, and it should hold above that intraday low over the ensuing days to be valid and to actually not to stop you out. So let's take a closer look at some examples here. Let's look at Netflix, and this is back from 2010, 2011. You can see the gap-up move. At this time, the 40-day average true range for Netflix was 6.26 points the day before the gap up, and 0.75 times that is 4.69. And on the opening, Netflix gapped up this particular day 24.12 points. Now, you calc that out, and yeah, that works. 24.12 is significantly more than 4.69, but you can also eyeball it. You can see here we use eSignal charts, any charting service that will allow you to calculate and show an average true range of 40 days on the bottom of the chart can be used. And so you can see here we're showing what the average true range is showing at the time of the gap up. So you can see that it's pretty simple to observe this. As well, look at Baidu from January, or actually February, I believe, of 2011, and you have a nice gap up move here on this particular day, and the volume is massive, and you can pretty much eyeball it given the context of Baidu's price movements over the past several months before the gap up. You can eyeball that, and you can see that that probably is pretty much more than 3/4 of the 40-day average true range. But for those of you who like precision, you can always have it at the bottom of your chart if your charting service allows you to show that, like we did on the previous chart. Now, in this particular case, the one thing about Bible gap-ups that I think makes them very viable and actually very safe to buy is that the intraday low of the gap-up day is your quick reference for a stop. And a lot of times, depending on the volatility of the stock or say its relative thinness, say. In this case, Baidu is tends to be a little bit of a wild stock, so you could give it, on this pullback, you can give it a little bit of room underneath the low here, and you notice it does close this day above. It tested this low, but that would actually be holding, so that would be okay. But you basically have the low of the gap up day as your stop out level. Add another % or two for porosity if it's a little bit of a wilder stock. And for those of you who've ever traded Baidu, you know that it can be somewhat volatile, at least in its younger days, since coming public in 2005. Now, if we look at another one, Priceline.com in August of 2010, this occurred on an earnings announcement. You know, and a lot of people think, oh, once an earnings announcement comes out, you know, the news is out, sell the news is good, sell the news. But in this case, when the news generates a huge volume Bible gap up like you see in this chart, you can see that you buy the stock on the day of the gap up, you use the intraday low of that day as your quick stop. The best stocks just continue going higher. So when these work, they work very well. And that may mean that you may have to buy a couple of others that don't work, but the beauty of this is that you're actually able to contain your risk pretty well and within a very tightly confined area, I would say. And generally when these do work, the movement never really comes back to test the Bible gap up day. You can see here's another one. This one's a little more subtle, but you can definitely see in the Rovi Corp back in September of 2010. big gap up here, use the low of this gap up day as your stop, and it really never looks back. So you get in, a lot of people, especially, let's say, for example, you own this stock, and it broke down below the 50-day moving average. We have the blue line here is a 50-day simple moving average. The black line is a 65-day exponential. I use the two of them together. They kind of create a band, but most people just use the 50-day simple. But if you see your stock drop below that, and the volume actually here you can see is above average when it does that, and then they'll sell out. A lot of times they just will not buy back, but we would actually be very willing to come right back, and I believe we may have owned this stock, I think, at the time, and we got stopped out as it broke down through the 50-day moving average, but we'll turn around and buy it right back on the basis of new evidence, which is the viable gap up. So here's a little shakeout, and then a viable gap up that takes you much higher. And this fits all the parameters that we're looking at. I mean, you can see if this blue line running along the volume level here is your 50-day moving average of volume, you can see that this volume spike is way, way above that. Here's another move. This is actually the Netflix move that we were looking at earlier. Riverbed Technology back in October of 2010, not that long ago, had a big move, and that all started with the viable gap up. And again, you can see that's very easy to buy using the intraday low of this day here as your stop, and that thing never really looks back. And once you're in, you've got cushion right away, and you can sit through all these little pullbacks and to manage a pretty nice position there to generate some pretty decent profits. Here we have Acme Packet in February of 2011. Again, the same thing. And so really what you want to do is train your eye to look at these things and to be able to see the magnitude of the move and the tremendous buying volume. That really think of it more as a rocket lifting off. When you watch before the space shuttle was mothballed, when you watch that thing take off and it's up half a mile in the air, it's not too high. It's about to head off into space. And I think that's how you need to look at these. Just think of the volume as being the flames coming out of the bottom and the exhaust of the rocket thrusting itself out of there, and this nice, beautiful trajectory higher and spike out of here is like a rocket taking off. That's really what it is. And when they work and they don't blow up on the launch pad, they can produce some pretty wild profits. And so for my money, it's one of the safest and most exciting buy points out there. And of course, it's not a panacea. Not all of these will work, but part of the solution to making big money in the market is simply doing your homework and putting yourself in a position to make big money when you're right, knowing that you may be wrong a couple of times. So not every viable gap up is going to work, but we find that when they do work, the results are often quite spectacular. And so it's a matter of buying enough of these and figuring out which are the best stocks and which to buy these viable gap ups that's going to make you the big money that everybody seeks when trading in the markets. Here's the Crocs move again. I always love to show this move because I remember at the time nobody would believe this, because after all they made these weird little shoes, these rubber shoes that were kind of ugly, but as it turned out they were quite comfortable. And it led to a huge move in the stock. But you just look at that volume spike and just imprint this on your brain. You can see that the buying volume is absolutely out of this world. And it really is just providing huge thrust for a rocket to launch here. We look at Google back in 2005. And this was back when it was starting its move. Price moved back at that point. It came public in 2004, had a move and ran up, then went sideways for a period of time into 2005, throughout a good part of 2005 actually. And then it started a whole new move with a big viable gap up. And there it is again. There's a huge volume spike. There's the gap up. And you're using again the low, the intraday low of the gap up day as your stop. Never a problem, never looks back. Here's Baidu again. Now this is this idea of porosity, and we want to show this because not all examples are perfect, and you do have to use a little bit of wiggle room depending on the stock that you're playing. Now in April of 2007, Baidu had only been public for a little less than 2 years. If I recall correctly, it came public sometime in, I think, June of 2005, I think it was. And I remember that only because I was on vacation at the time and saw this thing come public and just go nuts. But, Baidu had a big first day of trading, and then it spent the next nearly 2 years going sideways. And when it first broke out, it came out of this sort of a cup formation, and the pattern was much longer, extending back into 2005. But at this time you had a gap up, so you had a little bit of overhead from the left side of the pattern, as well as the fact that Baidu at the time was a very squirrely new issue stock. It was less than 2 years old, and it was still a relatively young stock, relatively thinner, and a little more wild. So what you would do here is if you gave it a couple of percent on the downside, you would sit through this little pullback. And in some cases where the stock is a newer, younger, thinner stock, wilder stock, you can allow for some of this. But it does show you that there are some exceptions to using this rule. But the other thing is there are other buy points, which hopefully we'll save for another webinar in the future, where you could re-enter if you were in fact stopped out. But sometimes you can allow for some porosity. Another technique that I might use is if I do buy the buyable gap up and it comes in like this, if it turns around and heads back up through the low of this, I may try and buy it back again, given that it's moved back into the range of the buyable gap. It's a little trickier, but I just want to illustrate that there are some exceptions now and then that will throw you. And so it's not always as clean cut as you would like it to be, but I think that's really the reality of trading. And again, it gets down to doing the hard work and taking the shots that put you in a position to make big money. So it's one thing to be lucky, but you have to create your luck by putting yourself in a position to get lucky. So, if you're not willing to ask a woman you have your eye on out, you're never going to get the date, and nothing will blossom from there, and it's kind of the same thing. Here we go. This is one of my favorite examples. This is Apple in October of 2004. And the fascinating thing about Apple, from my experience, was at the time, Apple was coming out of a base down here, and I remember buying 50,000 shares, and it would go up a little bit, and then not go anywhere, and I'd sell it, and then I'd buy it back, and then I'd ramp it up to 100,000 shares, and back it down to 50,000 shares, and finally, right at this point, I had 50,000 shares left, and I had an analyst working for me at the time, and I said to him, earnings come out on Apple tomorrow. I believe this was October 15th in 2004, and I asked him, do you think I should be adding to my position here going into earnings? And he told me he thought the stock was fairly valued, and it may have been at the time. But what's interesting is I was messing around with the position, just going back and forth, and it wasn't really very exciting. So it's boring you to death as it's slowly trending higher. And then you get this little pullback, and then boom, here's the gap up, massive volume. I turned around and started adding to my position, so I got myself up to about 500,000 shares of the stock pretty quickly. And this thing never looked back, and it really was the beginning of the huge move that Apple has had since 2004, and which only recently ended. And we'll see if the stock is able to set up again and go higher, after sometime in 2013 or beyond. But to me, I think it's probably had its biggest price move now, because I think the company now has the law of large numbers working against it. But back then, it was a buyable gap up that started the huge move in Apple. So when you look in the investment newspapers, the Wall Street Journal, Investors Business Daily, or you're on the internet and you see some ad for some penny stock broker or some penny stock guy telling you, come to us and we'll show you the next Apple when it's still a penny stock. And the bottom line is that good stocks, and particularly a stock like Apple, never is a penny stock because penny stocks are junk. What Apple was when it started its big move was a buyable gap up, not a penny stock. So I just want to point that to everyone, because you'll hear that, discover Apple when it's still trading as a penny stock. But Apple was a quality company from the start. It never traded for pennies or even for single digits. and the best stocks won't. And in viable gap-ups, you will rarely see a penny stock, starting out this way. But a viable gap-up was how Apple started its big move, not as a penny stock. So, and also back in 2005, there was another viable gap-up in Apple that occurred in July of 2005, which started out a new leg of its upside move that extended from 2004 to, say, 2012. And again, this started with a viable gap-up, and it went higher. So you can see this. It actually clears. You have some resistance on the left side of the pattern here, but you can see that it actually clears that pretty quickly, gets up a little higher, and then breaks out and heads higher from there. But there you have a viable gap-up. It's a little more subtle, and this one doesn't look as crazy because it's not as far up there, say, as this one was. But, I would say this one had a more profitable move, but this one worked as well. Here's Biogen most recently back in 2011. Some of you may have seen this move when it happened. But here was a viable gap-up, and that looked pretty crazy at the time. I remember seeing it, but it was quite viable, and it led to a nice move from there. Now, you notice it has another gap up here on this massive volume, and there is something to keep in mind when you're looking at these charts and seeing viable gap-ups within the patterns. And that is that once you have 2 or 3 or 4 of these occurring in a pattern, it starts to get a little bit old and it becomes a little bit too obvious. So, when you're getting this kind of a move, this thing's going vertical and then it gaps up. This is more of an exhaustion type move. So we want to distinguish a viable gap up from an exhaustion gap up. And so this I would not consider an exhaustion gap up because you're coming out of a nice, well-contained uptrend. It is an uptrend here, but it is well-contained and it isn't getting frothy to the upside. You can see after this gap up, you start to run straight up, and then you have this gap up. That's probably not one you want to buy because you're actually coming out of a position that is not within a consolidation or a well-defined, coherent, and contained uptrend. Okay? Now, we like to use, once you have a viable gap up and it's running up and running away, what do you do in terms of selling the thing? And we like to use a very simple system that we call the 7-week rule. And essentially boils down to this. 125. What we find in our work is that stocks will have a tendency to follow one of 2 simple moving averages, either the 10-day moving average or the 50-day moving average. Now, how do we figure out which one to use? Well, stocks that have shown a tendency to obey or respect or essentially hold above the 10-day moving average for at least 7 weeks in an uptrend, following a buy point, I should add, should often be sold once the stock violates the 10-day line. So, in other words, you buy a stock, it has a viable gap up, and over the next 7 weeks, it follows right along and above the 10-day moving average. At least 7 weeks, then you are going to use that as your selling guide. Now, let's say within 2 weeks after you buy it, it falls below the 10-day moving average, but holds above the 50-day moving average. Then you're going to use the 50-day moving average as your selling guide. So basically, if it doesn't show a tendency to obey the 10-day moving average, then it is better to use the 50-day moving average as your selling guide. This rule can help prevent you from selling a stock prematurely if it is simply not its nature to hold the 10-day moving average, and it tends to drop below the 10-day line quite often. So our studies will indicate that a stock within an uptrend which is also shown to obey or hold above the 10-day moving average for at least 7 weeks following a buy point, and that could be a breakout, standard consolidation or base breakout, pocket pivot buy point, which is another type of buy point we talk about in our books, or a viable gap up, and it should be sold upon its first violation of the 10-day line. And a violation is defined as a close below the 10-day moving average, followed by a move on the next day or on ensuing days that would be below the intraday low of the first day. Say that 10 times fast and you may still not get it. So let's look at some examples here. Let's look at Chipotle Mexican Grill from 2010. And you can see we have a magenta line that is your 10-day moving average. And you can actually see here that when it breaks out, this is a breakout from a base. And you can see that once it does that, the stock follows the 10-day moving average and it basically holds above it. Here you can see you have a close below it, but it never moves below that low. It never closes below that low. You do have a little movement here below, but it generally is holding it and obeying the 10-day moving average. So at this point, you get a viable gap up. And you're now, because the stock has been following the 10-day moving average for at least 7 weeks from this buy point, this is another buy point, it continues to follow above it, then you're going to use this as your selling guide. Now notice here again, you close below it, but that is not a violation because you need to move below the low of this first close for that to be a violation. So as we go higher now, you see we break below the 10-day moving average. Now here's your first close. But notice how it takes several days before you move below the low, but finally on this day it closes below there, moves below and closes. Now you're selling the stock, you're bagging your profit, and you just let it be until you see another buy point in it, a new buy point that may set up later on. And in fact, I think it did set up in a base and turn around and issue some pocket pivot buy points in the pattern. But you can see this is a very convenient and a very efficient way to bag your profits when you have them. And, I know a lot of people get hung up on a stock that they have that's accelerating to the upside. And, of course, you never sell right at the peak. And, it always brings up the old saying, when you got a stock that's moving straight up, you never know how poor you were until you started making a little money in such a manner. And people start to worry about giving it back. And a lot of times people will get caught in a break like this and they have no mechanism for figuring out how to get out efficiently and relatively quickly. And what happens is they linger too long and then the thing will really break down. But I think using the 10-day moving average with the 7-week rule in this case gives you a very tight and a very, very efficient selling guide. Now, let's look at an example of where we would not use a 10-day moving average. This is a viable gap up here. And the stock continues up for a couple of weeks, 2 or 3 weeks. And now you notice we close below the 10-day moving average. And then on this day, we're moving below all the lows of these closes. And so now what it's showing you is that it's not the stock's characteristic or tendency to hold the 10-day moving average. And it does so right away. So it does it within, let's just count the number of days. So that's 5 days is a week. So 1 week, 2 weeks, 3 weeks. So, within 3.5 to 4 weeks, it's already violating the 10-day moving average. So now that you see that, you now know that you're not going to use the 10-day moving average as your selling guide in this case. You're going to use the 50-day moving average. So that's really how you determine whether you're going to use a 10-day moving average as your selling guide, or whether you're going to use the 50-day moving average as your selling guide. It's a very simple concept. Here's Lululemon Athletica in December of 2010. Here's a viable gap up. But you notice that very quickly, here's the magenta line. Now, this one's a little fainter, so hopefully you can see it pretty well. But you can see very quickly it drops below there and moves lower and violates it. So you're not going to be using the 10-day moving average, and you see that right away as your selling guide with this stock. You're going to be using the 50-day moving average, the big fat blue line that you see here. And you can see that the stock does hold it pretty well on these pullbacks here. A whole series of pullbacks that extend for about a month, and then it continues higher. So very simple determination. You get the buy point. Does it stay above the 10-day moving average for at least 7 weeks? No, it does not. You use the 50-day. If it did, like the first example we showed, the Chipotle Mexican Grill, then you would be using the 10-day moving average. But in this case, Lulu did not, and so you use the 50-day moving average. And that pretty much is the scoop on buying viable gap ups. I know it's about 440 right now, and I believe we can take some questions, but just wanted to show, where if you're interested in finding out more about viable gap ups, we have an entire FAQ section, where we answer questions. It's all free. And, anything else that might tickle your fancy there, you can check out on our website, which you can get to very quickly at selfishinvesting.com. Also, we just came out with our newest book, In the Trading Cockpit with the O'Neill Disciples. It's published by John Wiley & Sons. and just was released within the last couple, 3 weeks, so it's fresh and hot off the presses. And I should also add that it is actually the only trading book that I've ever seen that's done in full color. So the charts are in full color, and so if you like to look at pretty colored charts, much as we showed in this PowerPoint presentation,
Someone wants to know,
you'll find
back to the Lulu chart.
really sort of a hands-on, get down, get dirty, roll up your sleeves, and get involved with the techniques that we use through a series of exercises, through trade simulations that we do in this most recent book, which is really a follow-up to our first book, which came out in 2010, Trade Like an O'Neill Disciple, How We Made 18,000% in the Stock Market. And so that's where you can check us out. If there's any questions that Dr. K, which is Chris Ketcher's nickname, by the way, for those of you who are unfamiliar with him, if there's any questions he hasn't asked, we could answer questions on here. So do we need both books for the average trader? Somebody asks. I think that if you read the first book and you find it compelling, then I think you could go to the second book. But I would say if you don't find the first book useful, and I understand that not everybody is going to find every book and every trading technique useful because they might not mesh very well with their own psychology, then you may not like it, and that's fine. That happens. But if you find the book to be useful, we think that the second book really helps you get down and dirty in terms of working with where the rubber meets the road and being able to train your own eye to catch a lot of these buy points and whatnot that we see in the charts. Someone's asking about an opinion on IGTE. Since I'm not really going to get into any stocks here.
Gil,
so
don't get into individual stocks, but go into a little bit of background. I didn't do that at the beginning of what your experience was with the O'Neill group.
Thank you.
Gil? Uh-oh.
Well, somebody asked a good question. What sort of drawdowns do you experience on the way to 18,000? And, risk and return go hand in hand, and a lot of them, a lot of the drawdowns could be 30, sometimes 40 or 50%, depending on where we were in relation to, say, pullbacks or intermediate pullbacks in stocks that we own. But we'll tend to have concentrated positions. So, yeah, there's going to be larger drawdowns. And I think that goes hand in hand with the whole idea of making these huge returns. It's not 18,000% that you can make as a result of just seeing something just go straight up, and you're up 100 and 500 and 1,000. There's no pullback. So, how much of the 18,000% was due to Apple? I owned Apple in 2004, and that produced a pretty good year for me at triple-digit returns. So, I don't know, less than 1/10. You can have large drawdowns depending on how many losses you take in stocks. If you get whipsawed a lot, if you're in an environment. I can remember in 1999. The market was actually very choppy, and I remember in October of 1999, Bill O'Neill called me and told me that he thought this market was through and that it was heading lower, and then within a few days the whole thing turned around and went up. But that was a very choppy environment, and I think Chris dropped about 50%, but he also had gains before that. When you've made a bunch of money before that, it's easier to sit tight. Someone says that I used to work for and with Bill O'Neill. I was actually the chief market strategist for William O'Neill, and had the privilege of working with Bill for 8 years. Chris Ketcher worked as an analyst, and he actually I chose him to work with me in helping with the institutional services. I should point out, people ask, where does the name O'Neill Disciple? And it's sort of an inside joke, because back in early 2000, there was a book put out by tradingmarkets.com, and I think you can still get it used. It's called Conversations with Top Traders. And they had one chapter where they interviewed Chris Ketcher and myself, and the title of the chapter was The Disciples. So the joke always was that we were the disciples, and we brought that in the title here. And it's a little bit of an inside O'Neill joke, but, we're not trying to be a little bit full of ourselves. We actually are disciples, if anything. So, Chris is commenting on the gap up in the DIA. I guess it's the diamonds. You've seen the market gap up today and volume was not really spectacular. It's still, we're in a positive uptrend, so that's all you can say right now. I notice there's a lot of junk off the bottom. When you get older, you'll be apostles, says somebody. Maybe so. I don't know, my kids have a lot of other names for me as I get older, but I won't get into that. There is no difference between our method and IBD. Or actually say CanSlim or O'Neill's work. Our view isn't that what we do, the methods that we have devised are our own techniques for handling the overall CanSlim methodology, or the O'Neill methodology as we refer to it. And so we're just adding our own little tweaks that we've worked on and discovered and find useful. You may find over time that you do the same thing, but we're just showing our techniques. And I will also say, Gil took CanSlim and expanded and improved it. No, I don't think so. Should point out that it was Chris Ketcher's statistical work that really defined, and I don't know if you would say discovered, it wasn't like Columbus discovering America, I suppose, but Chris is the one who actually codified the pocket pivots as well as the gap up moves. And there's also an original work. I think it's the gap up method. It's an old book from the 70s, but there was a fellow who used weekly charts and gap ups on a Monday morning on a weekly chart that would create a gap up in a weekly chart that would be viable. So, what is a proper setup for a gap down? Don't really use gap downs except on the short side, but I think that's something for another webinar. I did write a book with Bill O'Neill titled How to Make Money Selling Stocks Short. That's another Wiley title that was published in, I believe, December of 2004. So, in the beginning of somebody asked the question, are you going to talk about the technicals leading up to a gap? The gap is the technical, but generally what you will see before a gap is the stock is either in a very well-defined, coherent uptrend, or it's in a sideways consolidation. So I think Chris and I work very well together as a team, and we complement each other. And I think we've been able to expand on the work in that manner, and actually be able to create a very effective team in teaching other people how to use it. So, someone says I've been been advised to leave mega gaps alone. Not in every case, it really depends. A mega gap like that Biogen gap that we saw that came after the stock was going straight up, maybe that's a mega gap you should leave alone. But a lot of big gap up moves coming out of consolidations, or as we said, coming out of coherent shallow uptrends like we saw in Apple gap up in 2004. Like I said, I find that the most comfortable and easiest things to buy, and most people think you're nuts. So, anyways, is our time up yet, Stephen or Jim? I'm not sure.
You got as long as you want. Yep, this is very good information. Can you hear me all right?
Always and typing all the time. Sounds like a mouse on the wall. I went to Stanford. Dr. K went to Cal. right now Stanford has the axe. We also have the Rose Bowl trophy. So, but every year Chris and I will bet on the big game, the Stanford Cal big game. And I think right now Chris is actually ahead by a couple of bucks. We bet $1 every year, but we basically, it's like what the Fed does with your gold. It just moves it from one room to the other. So he gets if Cal wins, he gets a credit on his side. But I think the last couple of years I've won, so I'm taking back some money from the earlier part of the 2000s. We're actually based in Southern California. Our offices are located in Playa del Rey, in the historic financial district of Playa del Rey. It's actually an old brick building that was built in 1906 as the first bank of Playa del Rey. And now in our office, as well as the studio of Ruth McCartney, who is Paul McCartney's younger sister, believe it or not. Someone says Cal women are 3 points better than Stanford women. No comment, no comment. Sexist comment there, though. Anyways. We'll keep answering questions as they come up. I may start singing here, too. So, Cal women are not as smart. You know what? I actually think, and Chris and I agree on this, that I think Stanford, Cal, and Caltech really represent, say, the West Coast Ivy League.
Above 8 p.m.
And I think if my kids got into any of those three schools, I would be quite happy. I may not be happy with the tuition bills outside of, say, Cal, which is cheaper. Anyways. We do have an advisory service.
Guys, thank you very much. This was very informational.
Invest.com, which is the website that I pointed out. I don't want to do any kind of a hard sell. We think of ourselves as traders first and as investment showmen second. But we're always interested and happy to help people learn more about the markets and become acquainted with our techniques.
Gil, Chris, can you hear me?
Yes, I can hear you. Can you hear me?
Okay. Yes. Very good presentation. You got a good crowd here, and so what I'll do is I'll just kind of meld in here with candlesticks and see if we can.
Thanks, Steve.
Thank you, fellas, and I hope we can do this again sometime. As you can see, you grow good numbers.
Yeah, definitely.
Thanks, Stephen.
Thank you.
Good fun.
Thank you. Okay, everybody, I will, let's see, I will kind of just swing right into, I hope I can do this. We're hearing why these gap ups are so strong. Now we have the capabilities with candlesticks to see a lot better when they occur. So we're going to kind of delve away a little bit from the mega gap ups. I'm getting closer, getting closer. I think we've got it now. Yahoo! All right. Everybody see that screen? All right. Okay. So I tell people, and I've told people ever since day one, that candlestick signals and gaps are your best friend. You're going to make tons of money using both. And so what we want to do with using candlestick signals is learn the simple logic that's incorporated into a gap, which is basically that the price movement from one day or one time frame to the next, and obviously we're going to use the daily charts, is that there is such great enthusiasm in those chart or in that price that they gap it up above any of the trading range of the previous day. That is a message in itself. And if it's coming out of the proper pattern and or signal, that's where you make a ton of money. Can we take a quick break? All right, Manning. Yes, let's do that. We're going to take just take a 3-minute break, refill your coffee, check out the facilities, and then we'll be right back. I forgot that we've already been cranking here for a while. All right, so we'll be back in 3 minutes. All right, I'm going to give it 1 more minute. That'll be right at 7 o'clock. So I'll just kind of ramble here for a minute while people are coming back. But the biggest gains I have made in the markets through the last 35 years are usually related to gaps. Because if you just think about what a gap is a dramatic change of investor sentiment, which is well demanding the supply, and that's what gets prices moving. So, all right, we got everybody back. All right, so what we want to be able to do using candlestick analysis is also be prepared for those big price moves. There's 2 aspects of taking advantage of a big price move. One is getting ready for it if there's indications that there's a possibility of a big price move ready to come. Or 2, once a big price move occurs in that gap, as Gil was saying, that most people will stay away from it, because I would guess that 95% plus of all money managers stay away from gaps, because you don't know what they're doing with the price after that. And that's absolutely wrong. If you understand what type of price pattern a gap came from, or the magnitude of the gap, and what should be expected afterwards, you can make a ton of money. That's and as we say, our best friend is a gap. So let's see how we can identify those profit points. Number 1, a gap or a window occurs when the pricing is for whatever specific time frame is well above any of the trading range of the previous day. That basically tells you that demand has dramatically outstripped supply. So there's 4 types of gaps that we'll go through. Whoops, did I miss that? 4 basic gaps. Number 1, there's a gap up at the top. That usually represents exhaustion. Or there is a gap down from a signal from the top. That usually represents force. I think I'm going to be repeating these. A candlestick signal at the bottom, followed by a gap up, represents a strong force, and a gap down at the bottom is that final exhaustion down there. And I had that. 2 show force. That's the gap up from the bottom, and the gap down from the signal at the top. Those are where you're going to make your big money. The other 2 are exhaustion, which basically tells you get ready for a reversal. And when you see a gap up in an overbought condition, start watching for that sell signal. If you see a gap down in an oversold condition, what do the Japanese rice traders constantly indicate on their charts? Where do most people sell? They panic sell at the bottom. Again, that used to be me. And even as a smart stockbroker at the ripe old age of 21 years old, I kept thinking, when I'm selling down here, when all the indications in the world are to sell that stock, who the heck is so stupid to be buying? And I look back and say, well, maybe they weren't as stupid as I thought they were. So down here, that's the time to buy. Up here, that's the time to sell. So we have often shown on our charts that when you get up here and you're in the overbought condition, stochastics in the overbought area, and they're gapping it up, that's when you start looking for sell signals. Now, a couple advantages we have using candlestick analysis is, number one, the signal. If we see a doji in the overbought area where they've gapped it up, that tells you to start watching for a sell signal, number one. Number two, they were demonstrating how they use the 8 simple moving average, where we're using they were using the 10 simple moving average. We're using the 8 exponential, which are probably not that far away from each other. But some of the basic rules of from what we call the T line, the 8 exponential moving average, is if you see a candlestick buy signal and a close above the T line, you stay in it until you see a candlestick sell signal and a close back below the T line, with the caveat being the further away you move away from this T line and you see a signal, the higher the probability they're going to come back and test it. So this is starting to tell you to start taking profits up here. So what's the difference between this up here and some of the big gap ups that they showed us? The signal. If this had been a completely different signal where they opened it here and closed it up here, that's giving you a completely different message. Anytime we see that gap up doji at the top, it's time to start taking profits. Now, this is very beneficial for me because not only was I stupid to be selling at the bottom, but I was usually the one buying at the top. And I could never figure out when everything was so rosy and I was starting to buy, why as soon as I bought did it go the other way? Or why when that buyout rumor that I'm also getting buying because of it, that as soon as I bought, prices started going the other way. Now you don't have to be at the whim of rumors or somebody's analytical abilities to tell you whether a stock's going up or down. You can see it yourself, what the cumulative knowledge of everybody doing. And when they're gapping it up at the top, the Japanese race traders have told us that that's where you start taking your profits. This is exhaustion going on up here. This is where you want to start coming out of that trade. And if you see it occurring at what we know is a major resistance level, like the 200-day moving average, stochastics overbought. And remember, my stochastics are 12.33. They're overbought when they're above the 80 level, and they're oversold when they're down below the 20 level. So if I see an overbought condition, I start seeing exuberance in the trend. Where do we anticipate the target's going to be? Probably here at the 200-day moving average. Why can we kind of assume that? Because notice what the trend did down here. When it reversed, kind of flopped around here, couldn't get through the 50. When they got it through the 50, what did they do? They pulled it back to see if its 50 was going to act as support. When it did act as support, where did they take it? They're going to take it right back up to the next major moving average. Whoops, hold on for a second. I've kind of... Any chance you can make the projector bigger? Boy. Is everybody's projector smaller or need to be bigger? Hold on for a second. If I do this, okay, hold on. Let me put it on a bigger screen here. I'm going to take this high risk maneuver and close the projector for a second. Now, let's see. If I do this, what do I want to do? I want to get rid of this. How do I do that? No, that's not what I want to do. Ah, humbug. I've got the for some reason I can't get on my PowerPoint. I've got all the stuff going on at the top. We'll do this. We'll just make it a full screen. All right, here we go. It's like the little kid that. Okay. All right, where were we? We were way down here somewhere. All right, anytime you see a gap up and a gap back down, that's your abandoned baby. That's your most strongest reversal signal. So, again, anytime we see that doji at the top or a signal at the top and they gap it down, that means that's told us a story. That tells us not only after this indecision, they want to be out, and they don't want to be out. They really want to be out. That's going to cause a strong downtrend. Anytime I see that, now notice what happened right here. We had a gap up doji. It didn't confirm, but it was still a gap up in an overbought condition. That should tell us start watching for a sell signal. Went up one more day, did another doji. Then they gapped it down. And where were they going to take it when they gapped it down? Right here to the T-line. Now notice this is one of our best patterns though, is this is where you take your profits. It's in a downtrend because look how far away we are from the 50. And then notice what happens when we get right back to the 50. We can identify immediately what type of buy signals we're getting and whether it's time to be buying again. Anytime, notice how the T-line has been acting as resistance. Now here's that one of those gap ups. Again, when they gap it up, that's telling you a story. And now that what becomes very effective is, as long as they stay above the T-line, you're going to be in this, what I call the 45 degree. That's going to be a very strong uptrend. Yes, the T-line is the 8 exponential moving average. We called it a T-line because we didn't want to have to call it an 8 exponential moving average every time. So we were trying to figure out what would be a clever way, a clever message. And since we knew it was our trigger line, it's short for trigger line. Yeah, it's T for Texas. It's our trigger line or the T-line. We try to abbreviate everything. For those of you folks that are new here, we have a chat room that goes on every day with approximately 200 people in there, all in different levels of learning how to use candlesticks. And the nice thing about the chat room is that everybody helps out each other. So you're going through the learning process a lot quicker. And fortunately, I get a lot of feedback from people that have come back and said this is the best way for them to learn how to use something. Is as they're learning, they've got people to go ask questions and learn the probability or learn the probabilities, learn the way to use this stuff a lot faster. So there's a doji followed by a gap down. Notice how this gap down is a lot different than what's happened all the way up here. They couldn't really get it below the T-line until they gapped it down. That was the time to take profits. The other moving averages we have on here is the 200, which is the red, the 50, and the, I think that's the 20. And those are simple moving averages. And that's what everybody in the world, as far as a money manager, uses to make their investment decisions of whether they're going to buy or sell. The advantage, the reason we have it on here is because we got the advantage to see exactly what's going on in investor sentiment based upon the candlestick signals at those moving averages. So when we see a gap up in an overbought condition, start looking for sell signals. See a doji and a gap down, Where are they going to bring it to? The first logical target is the 8 exponential moving average, the T line, but we know it doesn't need to stop there. If it goes through, you're still in a strong downtrend. The abandoned baby, you're going to see that with some of the exuberance start showing up at the top of a trend. Then they gap it up and do a doji. If they gap it back down, that one-day island reversal is your abandoned baby. That's one of the strongest reversals. Will we get this part in the recast? Yes, this is all, I think, going to be one big, heavy presentation. That's why we kind of did it in a combination so that you have two different aspects to look at these gaps and how to take advantage of them. Again, the further away you move from the T line, the higher the probability it's going to come back and test it. If you see a doji, start taking your profits because more than likely they're going to be coming this way. The worst case scenario, if you're like me, is, boy, I'd hate to sell my position here and it just kept going on without me. Sell half of it. At least that way, if it keeps going, you're in a high risk situation, an overbought condition away from the T line. You're in a risky area, but you've gotten rid of half your position. You're still making money on the other half. If it does open lower, you close out the other half. You didn't get the absolute high. You got the fat part going up and got out near the right area. What is the difference between an abandoned baby and a shooting star? Nothing. As long as it gaps up one day and gaps down. It can be an abandoned baby. It can be a shooting star. It can be an inverted hammer. Whatever that indecisive trading is up there that gapped away from the current trend and then gapped back down, that indecisive trading was a signal that told you there's probably going to be a reversal. That's right. Now, again, for those folks that are new, I've been doing this candlesticks for 25 years, but before candlesticks came along, I was the worst investor in the world. And I was even a stockbroker for 8 years. Your qualifications to be a stockbroker was, do you know how to sell? Why do you want to be a stockbroker? Because I'm interested in the stock market. When can you get started? That was about it. Anytime I see a gap up, overbought, start watch for a sell signal. If I see a gap down, not only have I closed out the position, but now it's time to start going short. This is what we call a belt hold signal. Notice how it comes up, and then they gap it way up above the trading range and bring it right back down. And then the next day they gap it down. So this belt hold signal is being confirmed by a gap down, number one, and number two, closing below the T line. You can stay short as long as you don't see a candlestick buy signal and a close back up above the T line. Yeah, I see somebody's put the warning out there that when things were goofing up one night, I said, shoot, this is what you get for drinking so early in the evening. And somebody took me seriously and they wanted their money back. They didn't want to listen to an inebriated commentator. So no matter how hard I tried to convince him that I didn't drink, he still wanted his money back. Yeah, a lot of people want their money back because they find out I'm not inebriated. All right, there's your left-right, or your bearish engulfing, followed by a gap down. Again, that gap down is your force. This is also a gap down, even though it doesn't look like it. Notice what they did here. This is why the advantage we have with the green and red, or the white and black, whatever you make the color of your candles. But notice it opened down here and closed up here. If you look at this chart, it doesn't look like a gap, except for the fact that the next day they gapped it back down here and went this way. That's a strong indication the sellers are in control. Okay, yeah, let's see. Anything we have to watch for P's and Q's with communicating with the innocent? That's okay. So Also, notice the type of signal we have here at the resistance level, a hanging man. Confirm the next day, we're closing back below the T line. Is it going to come back up? When they gap it down, that tells us a different story. That we're probably in a very strong downtrend. You can be much more assured about going short at that time. All right, the gap down at the bottom. That's when you start looking for a buy signal. I've discovered in many years of trading that if you see a gap down in an oversold condition, and it's a big gap down, even if it's something like IBM, Dell, Priceline, one of the biggies,
H13 price
if they gap down 20 to 30%, that somewhere between 4 and 16 weeks, they're going to come back up and probably have filled that gap. So the question is, who is buying down here? It's usually the smart money that knows something's going on, and they started selling here. When the news was out, everybody was panic selling, and they're buying down here, which means that changes the trend, and you're probably going to fill this gap. So if you can buy something like quality of IBM and be up 20% over the next 4 to 16 weeks, you compound that. That makes for a very good living in big quality companies or big stock names. So anytime I see this gap down, and even more so if it occurs at a major support level, I'm looking for the buy to start, or the buying to come in as soon as possible. A gap down, a little slight, but then right back up the next day we have a bullish harami, which tells us the selling has stopped. They gap it up. There's a 2-day island reversal. If I'm not answering questions, I'll come back to everybody. Don't worry. I usually stay as long as people have questions. And as I say, afterwards we'll go to the live charts to show some of the things that are happening right now in the markets. Gap down, start looking for a buy. There's an island reversal. An island reversal can be 1 day, or it could be 1 month, it could be 1 year. But that island reversal usually tells you there's been a change of investor sentiment. And we can see that a lot more easily based upon candlestick signals. The information that we see in this signal on a bar chart, this would just be looking like a big down move. Except we can see on a candlestick signal, we've got a hammer forming after a gap down. That tells us our next prospect is we could start seeing some buying. And notice how far away this occurred from the T-line. So the question is, do you buy when you're still below the T-line? If the adage or the rule is that you want to see a candlestick buy signal when it closes above the T-line. You do if you see remember the signal is the number one criteria for looking for a reversal. The further you are away from this second, indicator or confirmation indicator, the higher the probability you're going to come back up and test it. So if this is a 8%, 10%, 20, 30, 40% move just to get back up to test that level, that's still a good trade, because what are we going to be doing? We're going to be watching to see what type of signal we have once we get back up to that first resistance level.
3 p.m. Above 8 p.m. Do not be short. That Whitem H13.
Yeah, so this, now, these type of things, now, where do you grab the falling knife? That's always the proverbial question. Now we can see where to be grabbing the proverbial knife based upon which candlestick signals are forming. Where does this downtrend end? When they gap it down and you can see the bulls start stepping in. Here is your best friend. That's when you've had a downtrend, you see a candlestick buy signal, you're well in the oversold area, and they gap it up the next day. Anytime I see a doji in the oversold area and they gap it up, that's your best friend. That you're going to make tons of money with that. We had the question today in the chat room of if the kicker signal is the strongest signal, then why is the doji with a gap up your best friend? Because every time you see a kicker signal, you're probably going to see 4, 5, 6 of these. So the kicker signal you go after right away, but you're not going to see them as often as what you were going to see with your doji gap up. And your doji gap up is going to be a very high probability, high profit trade. So we're looking to buy when we see the gap up in the oversold area, and we're looking to sell when we see the gap up in the overbought area. Just acts like a roadmap. Okay, I'm going to take a break here just to see if I'm missing anything. I usually bottom fish. Certainly don't consider anyone asking for help from participants and saying don't. This is to be winding up. Don't worry. Ask questions when you can. Don't worry. I talk fast enough to what measures do you apply to your stochastic lines? These are 12-3-3. And the only way I came up with those was just back testing to see when the oversold corresponded with the bottom and the overbought corresponded with the top. You can tweak it whatever way you want to. Yours might be 13-4-2 or 15-1-3. All I'm looking for is stochastics. I'm not buying the stochastics. I'm buying the price when all the indications tell me this is the bottom. And if I see a candlestick buy signal occurring in the oversold area, just logic says that's the time to be buying. If so, okay. For the large gap creation, does the institutional money jump into stock pre-market to create the large gap? Not pre-market. Remember, most institutions don't do anything pre-market because the volume is so low that it's going to kill them. They've got to do their trades during the market hours. That's why it is a market. That's where everybody comes to buy and sell. The gap up is that if on Tuesday afternoon IBM closes at 140 and come out with sparkly earnings, and the next day everybody wants in, there may not be enough stock for sale for everybody that wants to buy until you get it equaled out at 160. So you've got a 20-point gap up. But gaps are based on daily. Yeah, they are. The starting point is a 3-month now. I make my charts big enough where I can see what's going on right now, and I can also see what's happened in the past. A lot of times I'm just looking at over here. Then I'll kind of fade back to see what's going on back here. Okay, the idiot said, all right. So anyways, where is a gap in the overbought area not considered exhaustion? Well, if you can see, we're just coming out of a little J-hook pattern right at a resistance level, and they gap it up. That's telling us there's a whole new story. We knew there was a resistance, or everybody could see there was a resistance level there, and they're gapping it through. That's not a surprise to everybody. That's telling you they knew what was going on, and they didn't care about the resistance level anymore. There's still going to be much more upside. Down here, they gap it up. Here's our bullish engulfing signal that closes above the T-line in the oversold area. That makes for all good reasons to start buying down here at the bottom. Now, this is the reason that candlestick signals turn me around 180 degrees, because what's usually going on down here at the bottom? You've got, we don't need to be rude, but, don't worry, I'll yell at people. So, anyways, and I'll get to the answers here. I'll get to all of them. But what turned me around was because I used to be the seller down here. Now I'm not selling down here. I'm looking for the buy signal. So I'm trying to be in with the smart money. A bullish engulfing signal closing above the T-line. That's 2 good reasons. 3 good reasons. The stochastics coming out of the oversold. 4 good reasons. Opens positive. What do we want to see after a candlestick buy signal? We want to see the bulls are still there. In this case, they gap it open. Number one. Number two, they gap it up above this resistance level. So there's a bunch of reasons to be buying. And when do we look for a sell? When they gap it up in the overbought condition. That's the time to start looking for your sell signals. Doji gap up. That's your best friend. Sometimes it doesn't look like it, but you've got to remember what the message was right here. That they were indecisive, and then they told you which way they wanted to go. They gapped it up. Not only gapped it up, but they gapped it up through the resistance level. Stochastic's coming up. That's usually going to indicate there's going to be a good, strong uptrend from there. Inverted hammer, gap up. Close above the T-line. What else are we looking for right now to break through this downtrending channel? If we see buying, that gives us the roadmap to start buying at that level. A morning star signal. Big down day, a day of indecision. Third day closes more than halfway up this candle. This one gapped up and closed up here at the T-line. Stochastics in the oversold area. This is a perfect time to either be buying right here or be buying right here. If we miss this, we can still be buying here because what's this telling us? They opened up positive after a strong buy signal, number one. Number two, they opened up positive above the T-line. That's telling us the T-line is not acting as resistance anymore. We're probably going to be, lost the picture? No. Stochastic settings are 1233. Okay, still good? All right. Yeah, if you lost a picture, if you lose a sound, just log off real quick and log right back in. Bullish Harami. Where do people sell? They usually panic sell at the bottom. Bullish Harami tells us a story, tells us the selling has stopped. What do we want to see the next day? We want to see buying the next day. Well, they gap it up the next day. We want to be buying immediately. But what are we going to watch for our first resistance? Right here at the T-line. If it fails at the T-line, we're back out. We didn't lose any money. We may not have made a whole lot of money, but at least we got out of a bad trade, break even with getting out of a bad trade with some profit. The fact that it closed below the T-line tells us a different story. They're going to the next moving average. And I'll get to the kicker signal. Don't worry. If you buy immediately, where do you put your stop? Candlestick signals have very simple stop loss perspectives. If this is the signal that tells you the bulls are starting to take control, and it opens positive the next day, and you're a buyer, where would a close have to be to tell you that the bulls aren't in control anymore? If they could close it more than halfway down the candle that told you the bulls were in control, you want to be right back out of it. I've been in the business for over 35 years, and you have every investment advisor telling you, cut your losses short and let your profits run. And in the last 35 years, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Candlestick signals have very simple techniques to say this is time to be back out. If this opens here, you don't want to see it close back below the halfway point of this candle. If it opens here, you don't want to see it trade at all back below this level. If it does, it's not doing what it's supposed to. Yes, the inverted hammer is different from a hammer. I'll try to show that as we go through here, if we have one. This is a little bit of an inverted hammer where the tail's 2 times greater than the body, which this isn't quite, but the tail's to the upside. What you want to see is they want to see them gap it open, and what did they do when they gapped it open from this little doji type day? They gapped it above the resistance level. The next day they held it above there. I'd still be a buyer. Where do I not want to see this close now? Back below the T-line. I'm going to hang on to it. Why? Because this gap up told me there's a strong force starting to push us this way. Doji, 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 flat. Doji followed by a gap up is your best friend. Anytime you see a flat area that ends with a doji, which is an inordinately high percentage of the time, whatever way they gap it, they're going to take it that way for a while. So if I see this setting up and the next day I see them open it positive, I can buy immediately knowing that I've got an extremely high probability we're going up from here. Where's my stop loss? If it opens positive, it shouldn't come back down below the doji cross. Yes, and if you go to our website, Theo, we've got 1,300 pages of free information. We've got all the definitions of the signals in there. I've written 3 books on candlestick signals, hopefully make it easy for people to understand it. Again, what does this gap up tell us? Notice it gapped up here and pulled back. A lot of people say, well, that's bad, except for the fact that they gapped it up. That's telling us a message. Then there's some profit taking. So what do we want to see before we're buying? We want to see that the profit taking's over, which is the bullish harami. Tells us we're in a good, strong uptrend. Anytime you see a doji followed by a gap up, you want to be buying immediately, especially if you're in the oversold area. It's going to start a very strong uptrend. Anytime you see a gap down in an oversold area and you see a candlestick signal, get ready to be buying. That gap is your message that there's exhaustion. It's time to look for a reversal. These are some here repeats. Here's the place to buy because we had a gap up and a close above the T line. That gives us a message. Where's our resistance level? Right here. But they gap it through the resistance level. What does that tell us? That tells us everybody and their brother could see there was a resistance level here. And not only did they go through it, they gapped through it. That told us this resistance level is not going to slow things down. Start looking for your next resistance level. Oh, Shanna, you're going to have to, whatever signal it was that you're looking at, or if you can, I can't even read the charts either. Try to find something, again, about 3 charts ago. Let's take a little, right here. Is this it? So why, on this one, if I was watching this and this is a doji gap up, what was it doing? It was bouncing up off the 50. I'm buying immediately, if that's the one you were referring to. Don't worry, we've got plenty of charts to, no, it was the one with the harami after a gap up that traded down. Oh, okay. This one. I was probably buying here. Then it gapped up, and people will say, oh, shoot, this is a dark candle. Is that bad? Number one, where are you with the trend? You're just starting the trend. So this is a gap up with profit taking. If I haven't bought, what am I looking for? I'm looking to see that the profit taking is over, which occurred the next day immediately when they opened it positive and started trading it positive. That told me one thing right away, that the selling was done, the buying was coming back in. So I could be buying anywhere in here with a very simple stop. But if I'm buying on this day, they better not bring it back down through the open. That's going to be my stop. If they brought it back down through there, the sellers are in control. So there's a lot of very simple logic put into candlesticks because basically you can see what's going on between the buyers and the sellers and what shouldn't be happening if you're buying. By profit taking, you mean short covering? No, not necessarily. Let's see. I'm back up here again. Where was it? Oh, they're buying. Somebody gapped it up, and then it was probably some profit taking because if some people are buying down here, traders are buying here, they're going to start taking profits. Well, I think it's in an uptrend. I want to be buying. I'm just going to wait until, because I know it's an uptrend because we've got buy signals down here, and then a gap up. We're above the T line. Stochastics are coming up. I'm just waiting for the profit taking of this day to be over, which occurred the next day. Then that's where I'd be buying. And so we did that one. We did the gap up at the top. This is when to take profits, is when you see that gap up doji shooting star at the top. Stochastics in the overbought area, and they gap it up, and you're that far away from the T-line, start taking profits. If you see a doji at the top followed by a gap down, or any signal followed by a gap down, get out of the position or start going short. Let's see. We've seen some of these. Yeah, we saw those. Now, down here, this is a kicker signal. Notice how on this day they opened it here and they closed it here, creating a dark candle. The next day they gapped it open above the previous day's open, and they went this way. That means they've kicked the investor sentiment in the opposite direction. There's a kicker type signal. Notice that you're in an uptrend. This was always my downfall, that I'd be happy. I finally got a winner. I'm going to buy my new boat, my new car, my new golf clubs. Then the next day they gap it down below the previous day's open. And my first hope is, man, maybe they can still take it up. If they're gapping it down in an uptrend, in an overbought condition, there's only one thing that you want to do. That's close the position immediately, because if they're in an uptrend, they shouldn't be gapping it down in the opposite direction. All that tells you is that's where the bears have found control. Opens here, closes here. They gap it up. The bigger this gap up is, the more strength you're going to see in this next uptrend. Kickers are gaps. Even if they open and right here, they've already gapped from this level up to this level. The bigger this gap up, the stronger that uptrend is going to be. A doji gap down. You want to go short. This is where you kind of analyze, where are you going in this trend? If you're in a downtrend and they start seeing indecisive trading and they're gapping it back down through the T-line, you want to remain short also. Gaps at the breakout points is much different than a gap in the overbought condition. If they're gapping it up through a resistance level, that tells you everybody can see that and they're going to go further with it. Or if they gap it up going into a resistance level, that means they can still see that there's a resistance level here. Won't be, smart money's not going to be gapping it up knowing there's a resistance level right there unless they plan on taking it right through. There's the resistance level. There's a doji. They gap it up through there. You want to be a buyer. There's a lot of people say, I don't want to buy a stock that's already up 3, 5, 10, 15, 20, 40%. You do if it's coming off a signal or a pattern, because that's exactly what we're looking for, is what is creating a force that is going to start moving a price up or down. Right here, coming out of a big fry pan bottom, where did it break out? Right about at the handle, or at the beginning of this fry pan bottom. Told you there was going to be more upside. How do you find these stocks, Chris? Oops, lost my headset. The breakaway gap is usually going to show up on a very simple scan. Which stocks have had the biggest percent move today? That's a very simple scan. I've got a few scans that in less than 20 minutes each day, you're going to be able to find the best 2, 3, 5 trades. You're only going to need 1 or 2 if trade. Drinking again. And we recommended GNGN just a couple of days ago. Why? Look at the fry pan bottom. Then it looked like it came up, failed the near the 200, pulled back. Then what type of signal do we have here? We're at the end of a fry pan bottom and starting to whipsaw, and they do a kicker signal. We're still holding this. It was a little bit sloppy today, and I don't have that chart up. We can get the chart up when we go live. But again, this all just puts us in the probabilities of being in the right place at the right time, and not only being in the right place at the right time, but we're going to be getting into positions where we're not going to be profitable. We're going to be much more profitable than a normal price move in the market at this time. We recommended LTD just a couple of days ago. Why? Because look at the series of dojis down here, then a gap up through the T-line, then they gapped it up again. What do you think's going on in investor sentiment when they've got a doji gap up, then another gap up? They're going to take this higher. They're probably going to bring it back up right here to fill this gap, which if you're trading options, I mean, you can find one that's going to move very fast, like a 4, 5, 6 day period, move 5 or 6 points, you're going to make a heck of a lot of money with your option trades. What is this one telling us? Is that an island reversal on the previous one? Yes, it's also an island reversal. Forgot to mention that. Island reversal, a series of indecisive trading, a gap up through the T-line, a break up above, a gap out above this downtrending channel. Stochastics coming up, gap up, gap up. There's a lot of force in this one yet. And what is this one telling us? Well, they gapped it up out of this kind of flat area. We're way up in the overbought area, and they gap it up, and they do a big candle. What should you be looking for? You should definitely be looking for your profit taking here pretty soon. Exactly. All right, so what's the difference between this being in the overbought condition and gapping up and this one right here? We're basically now coming out of a J-hook pattern with a gap up. Stochastics coming up. Stochastics are now in the low area coming back up again. Had a big day, but closed off near the bottom of the trading range. What was this going on up here all day long when they took it up? There was some profit taking. If it opens positive tomorrow, the Japanese race traders say the profit taking's over. They're going to take it right back up again. And if they do, what are they doing? They're confirming this J-hook pattern. This is your best friend. Doji gap up. That's what's going to occur an extremely high percentage of the time. So I think, yes, when you're using gaps and candlesticks, you're going to see an extra show of force in that next price trend. So I guess if those guys gave a little bonus, what we're doing too is if you want to, we've got a couple packs showing all the the gaps at the bottoms and the gaps at the top. Let's see if I did this right. Yeah, if you want to go to that link, I think there's a 50% off on this information. All right, while you're all pondering that great deal, I'm going to go up here and see if I missed anything. Do gaps work the same in Forex markets? You don't get gaps in Forex markets, unfortunately, because it's a constant roll. So very rarely do you get gaps. Where would you buy the kicker? You buy a kicker as soon as you see it. Because essentially what's happened is if you see a dark candle that went down yesterday, and today you see that they've gapped it up and they're going positive, just buy it because you know there's going to be a lot more to the upside after that. That is a significant gap that probably be called impulse gap physics. Okay. Let's see. Do they have, right now, as a matter of fact, I've sent 3 more formulas over to Jeff Gibby at Metastock this evening. I've got about 4 or 5 more to complete the whole set of 18. Lionel, our website is $97 a month, and what you get with that is each day the chat room is open. Each Monday night we do a training session like this for members. We do the free session like this on Thursday nights, but we used to sell a lot of our material. But what we're doing now is, like on a night like tonight, we just happen to do this because of Gil and Dr. K wanted to come in and do gaps, so we kind of combined them. But about 2 or 3 times a month, we will do private training sessions for members, which might include stop losses, how to put on effective stop losses, entry and exit strategies, how to improve your probabilities of being in the right trade at the right time based upon the simple logic of entry and exit strategies, how to do the scans for your best trade. So each month, that $97 is also includes maybe $200, $300, $400 worth of training that you don't have to pay for. That's all free to members. Each day in the chat session, I will come in maybe 2, 3 times a day, usually at the open for an hour, sometimes 2 hours in the morning. I'm sure I talk everybody's ear off. Then I'll come back in here for the close to see what we should be doing. But essentially, it's so that you've got a constant rolling of education, so that none of this is formulas. You don't have to know any formulas in candlesticks other than the number 2, and that's because you've got a tail 2 times greater than the body and a hammer, inverted hammer, shooting star, and a hanging man. I put out 2 or 3 stock picks every night, not so that people have stock picks, but so people can see the video and see what the rationale was for those stock picks. To just tell people what to do doesn't do them any good, because you're not learning anything. It's like I illustrate it with the guy that's driving down the street drunk. The cop blows his whistle, pulls him over. He looks in the back seat. He says, "There's a penguin sitting there." And he goes, "What the heck are you doing with a penguin in your back seat?" The drunk said, "Oh, I found him out on the street and I don't know what to do with him." And the cop said, "Well, take him to the zoo." The drunk said, "Oh, that's a good idea. I didn't think of that." Well, the next day, the cop's standing there, and here comes this car weaving down the street again. He blows his whistle, pulls the guy over. It's the drunk, walks up to the window, looks in the back seat, and there's a penguin sitting there. He goes, "I thought I told you to take the penguin to the zoo." He goes, "I did. He liked it so much, today we're going to a baseball game." So if you don't understand what you're doing, it doesn't really mean anything. So that's why we try to keep it as a constant learning process. All right, let's see. Yeah, I have a lot of drunk stories. That's right. All right, if we want, let me do this. If we want to stay on for a while, I know we've kept everybody on here for a while. You want to look at some live charts. If not, we can call it a night. All right, well, hold your live, the charts. Let me move these charts over. All right, this is dangerous. I'm going to turn off the projector. Close this out. All right, so as we can see today, we had a nice day, different than the previous days. Notice each day over the last 4 days, they would take it down in the morning and they would bring it up in the afternoon, which was a good bullish sign. Plus, notice what type of signal we had right here. We had a big price move. Then what usually happens after a big price move? It goes into a 45 degree. So as long as it stays in a 45 degree, we're all right, but now we might be starting to see some exuberance. If they start showing exuberance, that's where we start looking to take profits. But you can analyze this whole chart of when to be buying. There was our Morningstar signal away from the T-line in the Dow, closed above the T-line, stayed positive until we had a bearish Harami tells us the buying had stopped. Bearish engulfing, closing below the T-line, took us down to the 200. 200 acted as support with a bullish engulfing. We were buying right back again here, and we're staying long as it doesn't close below the T-line. Let's see, what was it? DNDN. This is, again, the kicker signal. They closed it down here. They gapped it up. We're still in this 45 degree, and this could be a very strong price move because of this signal right here. Whoops, I better put the VSH was, whoops. VSH, a nice rounding J-hook type pattern. And new folks, a J-hook pattern is very simple to follow. This is wave one. Very strong price move. Where did it start getting to where it's going to be profit taking? When some exuberance started showing up here at the top. Profit taking, and then it showed that the profit taking was over. Indecisive trading, left-right combo. We're back above the T-line. Now they gap it out through the top. If this is wave one, this is wave two. Wave three will be about equivalent to wave one. So that's a very nice chart. And in my dyslexics type trading or typing, I also came across VHS. Oops. VHS. S dot VHS. Which was a strong move. Now look at our little rounding bottom. This rounding bottom has a very strong result to it. That it will usually create a slingshot effect to the upside. I can't remember, I can remember which ones they were, I just can't remember when they were. But the slingshot effect, there's one back here somewhere, right here. I can remember this one because I bought options on this one. And so, you're buying options at 2, and a few days later you're selling them out for 6 or 8. Makes for good option trading. All of this really does is just puts us in a position to be in the right trade at the right time. Soda. This one, all you can do is stay in it as long as it knows how the T-line is acting as support the whole way up. Here's a place where you might have closed out. Because notice how far away you were from the T-line. And then you had a bearish engulfing signal. They open it lower the next day. You stay short or stay out until you see there's an inverted hammer. The inverted hammer has a tail 2 times greater than the body. And then what do you want to see on the inverted hammer? The next day you need to see it open positive. That's the confirmation. You're back up above the T-line. You stay there until you see a sell signal and close below the T-line. What was the previous signal? Was that VHS? I can't remember which one it was. We were given an illustration on with CIE a while back. We also made good money with PS, and I say make good money because once you see these rounding curves, this is what we're expecting. And so this one produced some very good profits. And so notice what's happened on a big price move. I think this was it up 38%? I sell half the position here because what's the logic of that? That Most people are happier than pigs in doo-doo to make 10% a year with their portfolio. If you're making 38% in one day with a position, take some profits. So it close out here. The next day they're trading it down. I close out here because what does the bearish Harami tell me? The buying has stopped. They're bringing it back. Now they're starting to set up again. Notice indecisive trading. They can't get below the T-line. Now you have an inverted hammer. So you've got a hammer, doji, hammer, inverted hammer, all on the T-line. If they open up positive, what's that telling you? Telling you they've confirmed the hammer or the inverted hammer signal. If they confirm an inverted hammer signal, the probabilities are extremely high, probably 90% or greater, that you're going to be in an uptrend. If you're in an uptrend from here, what's that do for you?
That
Breaks this downtrending
price crossing
pennant,
under 8
left,
average. That white
and price starts a J-hook pattern.
Tick,
what tells us to get out?
Below ATM.
If we know 90% of the time or greater, we should be moving higher from where it opens. They should not be bringing it back down below this level. If it does, you get right back out of the position. On, what was it, Citigroup, I think, did they miss their earnings? But notice, this is where I tell people, observe the obvious. Are you in an uptrend or a downtrend on this stock? Well, obviously, you're in a downtrend. So every time you get up near a support level or a resistance level, notice what we had here, a hanging man with lower trading. If this opens lower tomorrow, you want to be shorting it because where's your next target? You could probably draw a line down through the bottom of this trend channel, and that's where your short position should be going to. Oh, corn. Corn is, this is the March corn. Same scenario. Oh, did I do that wrong? I'm sorry. That was corn. This is Citigroup. Citigroup had a doji with a gap down. Now we're in an uptrend, but whenever you see a doji followed by a gap down, stochastics rolling over, where do you think you're going? You're going down probably to the next major target, which is the 50. What's your best friend? The doji followed by a gap up. That started your uptrend. Looks like an island top. Yeah, a little bit. All right. Facebook. Facebook. Bearish engulfing. Up, away. Now, you've got a trend channel. You can see this trend channel. I guess you can see it. And do something like this. And something like this. So at least if they start bringing down below the T-line, you know your next target is possibly down here or the 50 by the time it gets up there. So if it opens lower, if you own this, there's your number one criteria. There's your sell signal. And it opened lower the next day, close out the position. Is it going to hold here at the T-line? We don't know that yet. If it opens lower, it's not. It's going back down to the bottom of the trend channel. If it opens positive, you got a J-hook. You can always buy it back. Slow stochastics. And remember, stochastics aren't your golden goose. All we want to know is, are we seeing a buy signal in the overbought or oversold area? Logically, if we see a buy signal in an overbought condition, that doesn't really mean much. If we see a sell signal in an oversold condition, that doesn't really mean much. What we're looking for is the buy signal in an oversold condition or a sell signal in the overbought condition. That's what the Japanese rice traders are instructing us to look for. Because we're not going to hit every single trade correctly. But if we can hit a good probability of hitting the trades correctly, that we're going to be a lot further ahead of everybody else, number one. And number two, at least there's a logical format for every trade setup. Here's Sienna, which we recommended today. because we had a morning star signal, a big down day. Usually a morning star signal has just one day of indecision, but we had 2 days of indecision. Part of that indecision was a doji followed by a bullish engulfing signal. That's our, what we call our left-right combo, very strong reversal. Next day, big up day, makes this a morning star signal, and it closed above the T-line, open positive today. Now, what do we know about the rule of a doji? We know that the price is going to move in the direction how they open it after a doji. So if this opens positive, and I can't even see where the darn, I guess it closed right here. If this opens positive, you want to be buying immediately, because the next chart pattern that we are aware of is what we call the doji sandwich, which is a big price move, a doji, a positive open that tells us that they're going to move it in the direction how they opened it, another big candle, usually equivalent to the candle that was right before it. Makes it a very good trade for day traders. Okay, if you're shorting Facebook, bah humbug. I don't know if they did anything after hours, but if it opens weaker tomorrow, yes, you should be shorting this. It tells you the T-line is not going to act as support. However, if they open up positive, I wouldn't be shorting it until it comes back down below the T-line. Otherwise, you're in a J-hook pattern, which could continue this uptrend. Let's see. If I'm skipping your question or your symbol, just do it again. I had to start someplace. No, the Japanese did not have stochastics or any other indicators. When I started reading about candlestick signals, part of the book instruction was that you took a box and you cut a hole in the top of the box, you put a plate of glass over it, you put a light underneath it, and you put your rice paper on top so that when you were making your Japanese candle charts, you could see them that much better. Bidu, are you in an uptrend or a downtrend? Right now, it looks like you're in a downtrend. Got close to the resistance level. You're right here at the T-line. Your stochastics are rolling over. What are we looking for? If they open this lower, you want to be shorting it. You want to make sure it gets through this upward trend channel, but the overall trend looks like it's still down. If it moves down, where's your first target? The 50, which acted as resistance up here, to see if it acts as support down here. If it doesn't hold at the 50, where are you going? You probably want to draw a trend channel all the way down here to see where they'd be taking it. Disney, uptrend, gapped it up today through this level, off of bullish signals, stochastics coming up. I'd be a buyer. I just used the halfway point of this candle as my stop. It shouldn't close back below that halfway point. Las Vegas Sands. Las Vegas Sands. Rolling over. You got a shooting star doji. A doji. A hanging man in a doji. Bullish engulfing that didn't confirm. Now you have a doji. And what's our rule about a doji? They're going to move it in the direction of how they open it after a doji. So stochastics rolling over. If they open this lower, you can start shorting it because that means the T-line is not acting as support anymore. DDD, this one all you can do is stay in an uptrend until you see a sell signal. Notice how it uses the T-line as support. You've been in the overbought area for a while. Just stay long until you see a strong sell signal. Let's see. GLD, is that the S.GLD? Notice how it failed here at the 50, and it's right between the T-line. You're probably going to be on a T-line squeeze. That gold, this gold trust. Gold itself basically did the same thing, except it did it between the 50 and the 200. You're in a downtrend. If they can't get through the 50, they start seeing sell signals, you're still going to be in this downtrending channel. Silver, still in an uptrend, but also running out of steam in the stochastics. It could be looking for this level right here, or it could be looking for this little level right here, which says the 50 would be a resistance level. Let's see, gold, silver, ANR. Let me take a break here for a little bit and show you some of the ones that I think look attractive. ANR is in the slow, steady uptrend, but you're below the T line. Stochastics will get toward the oversold area. I wouldn't be long or short until I see a signal. Or right now, if I was short, I wouldn't be going long until I saw a close above the T line. Let's see, CYH. CYH. I picked this one out because there was our buy signal. Left-right combo, gap up, strong price move. Now we have kind of a shooting star gap up. It may not be the top, but it's probably getting you pretty close to the top. If it opened lower tomorrow, I'd be taking profits, or at least use this level right here, that if it came back down through the low of today, they're probably going to come back down and test the T line. Let's see, BC, well, Shazam. BC, little J-hook pattern. Notice we have a doji gap up through this little level, and now we've closed at a high. This one you can still be buying. MENT, another J-hook, bullish engulfing, close above the T line. Wave 1. Notice wave 1 started with a nice strong morning star signal. Wave 2 pulled back with not really a strong signal. So that would give me the indication that this is more profit taking than it is a reversal. Now you can start buying with the anticipation that if this is wave 1 that moved 4 points, that from here to maybe 20.5 is your next price move. Oops, I've scrolled way up here, and I don't know what's going on down here. All right. Is your left-right combo the same as the cradle pattern? No. A left-right is let's see if I can find one. I'll point them out if I see one. Let's see. This is your best friend. Here's your doji followed by a gap up. Very strong price move. Notice also when it got to the breakout level, no hesitancy. They went right through. S.FCX. Uptrend or downtrend? Well, you can see they gapped it down. They tried to bring it up, but now you've had a little doji hanging man, then a gap back down, and you're below the T line. This one, I'd be going short on any weakness tomorrow. Where's your next target? Probably coming back down to test the lows. DNDN was that kicker signal. Notice it opened here, closed here, gapped up, went higher. I would suspect you're still going to be in a strong uptrend. Now, today, people worry. We're getting what we call bearish engulfing signal because it was down here. Except the fact that we were not in the overbought area. Where does a bearish signal usually want to be working? When you're in an overbought situation. Left-right combo. Did I get the left-right combo? Here's a little left-right combo. Doji, which is an indecisive trading, followed by a bearish engulfing signal. Pretty much tells you after that indecisive trading, that big bullish engulfing signal tells you where they're going to go, and that usually sparks a very strong uptrend. I've done a quantitative recording showing, I think, about the 18 strongest signals in order. A lot of people ask, well, which signals are the strongest? None is stronger than any other. It might be this month that the hammer signals are strong because the market was doing kind of a hammer reversal. Next month, it might be the bullish Haramis. The next month after that, it might be shooting stars. All depends on what the market conditions are. But the strongest, as far as seeing them over and over, is the best friend, which is your gap up, your left-right combo, which is your doji bullish engulfing signal, your kicker signal. I can't remember which ones are in order, but anyways, we're probably going to be going through maybe a Saturday session here pretty soon, going through the ranking of each one. GNRC is a big fry pan bottom. Where did the fry pan bottom start? Right about here. A doji, right here at the same level. Stochastics coming up. Now, the difference between a signal and a pattern is, notice where it's about ready to break out. It's about ready to break out when the stochastics are back up in the overbought area. That's where the exuberance starts coming back in. This is investor sentiment. Negative, flat, starting to turn positive, getting more positive. Now ready to break out for a big move to the upside. Dell. Oh, we were looking at Dell and I forgot to go further. Dell apparently has a buyout rumor going around. So, do you buy here? Well, you know where to stop. If it opens positive, you can be buying. But it better not come back down through the low of today. If it does that, you've got a bearish engulfing signal. You want to be right back out of it again. And that's what usually killed me was I would think if I didn't buy this rumor, boy, this would be the one that finally worked because the 40 or 50 that I bought before that sure didn't work. Now I can look at the chart and see whether I'm the last man in or whether nobody knows about that rumor. And if the chart looks good without the rumor, I can be buying. And the rumor just adds more fluff to it. Here's a doji followed by a gap up, a positive open. You can still be buying this one. Are you using the cycle move and stochastics to help determine the wave number? No. My wave number is just 1, 2, and 3 because I'm not holding long term. I'm a swing trader, so my average trade is anywhere from 2 to 10 trading days. So I don't care. Once wave 1, wave 2, and wave 3 is over, I start over again with wave 3 being wave 1, looking for wave 2, and go on from there. I'm not an Elliott wave enthusiast. I've sat in too many meetings where you put 10 Elliott wave people together, you look at one chart and ask them which wave you're in, and you get 40 different answers. Here's the doji gap up. If this opens positive tomorrow, you can still be buying. It will be breaking out through this uptrending channel. Let's see, IBM. We're still on eBay. Why did we do that? S.IBM. IBM's kind of sideways and soggy. Notice the rounding top. This is called the opposite of our fry pan bottom. This is called a dumpling top. And a dumpling top usually will occur where it starts rolling over and then just does a slingshot effect to the downside. Yeah, I'll show you what wave 1, wave 2, wave 3. And it's nothing more than just counting them up move, pull back, up move. Cores, I wouldn't be long or short this stock. There's some stocks that don't have a trend enough to worth trading. Even if it went from here to here on a $50 stock, if it only moves 4 points, that's 8%. My minimum is if I'm going to put my money at risk, I want to find a chart that's going to give me at least 10% return if it works. Now, I know every single one's not going to work. But if it does work, I want to at least be rewarded by at least a minimum of 10%. If it doesn't work, at least I've got a 2, 3, 5, 7%. I don't want to be looking at a chart that's going to give me a 6% return if it works, because if it doesn't work, it may only give me 1 or 2%.
that whiten H13,
and there's plenty of charts out there that will give you a much stronger return.
Below 8
AMRS,
not be long, that whiten
there's
H13.
a bearish Harami gap down. Is this, am I seeing what I think I'm seeing? What was the volume today on this? I can't tell whether it was, oh, maybe that was something different. Anyways, if there's good volume, now you can't even short it because you're below $5. PSX, notice how it did a little bullish signal right here, right on the 50. Now we've got a doji right here at the resistance level. This makes it very simple. They're going to move it in the direction of how they open it after a doji. If they open it positive, we got two things happening. One, they're breaking it out through this level, and two, they're going to probably do a doji sandwich, which means this candle right here is going to equate to this move right here. And if that happens, that tells you you're definitely broken out through this level or this level. It's probably going higher. UNXL was one of the ones that we recommended. Notice here's your cradle pattern. Somebody was asking about a cradle pattern. That's a big down day, a flat, indecisive trading, and then a big up day, more than halfway up this candle. That usually sparks a strong price move. Now it's pulled back to the T-line and pulled back today. We bought it. I bought some today, or yesterday when it did a bullish engulfing signal. And probably jumped the gun because the more prudent thing would have been to buy it on a positive open today, which it didn't move positive. So the position that I've got, now I've got to decide what to do with it. It closed below the T-line, which means the only way I can keep this tomorrow is it has to open positive and trade positive to stay in it. If it opens lower, you close out the position immediately. Let's see. ISRG. This is kind of a booster reversal. Notice they took it down and then they took it up. That means there's going to be some more upside, but it's not a signal. It's not a bullish engulfing signal. It's not a piercing signal. It's just an up day, which means you watch very closely to see what happens when it gets into the resistance level. AMAT. Irish G, thank you. AMAT came out of a little J-hook pattern and started the next move to the upside. You continue to hold until you see a sell signal. So these candles work in all trading or better trading one than others. If so, works best with what kind of trading? Let me see if I can figure out what that. So these candlesticks work in all trading. Yes. Remember, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick signals are merely the graphic depiction of what's going on in investor sentiment. That's why the Japanese rice traders have found such an accurate trading method, is because investor sentiment works the same way in particular types of areas of a trend over and over and over. From 1 minute, a 1 minute chart, a 5 minute chart, 15-minute chart looks just exactly like a daily chart, a weekly chart, or a monthly chart. And investor sentiment works the same way today as it did yesterday, last week, last month, last year, last decade, last century. Investor sentiment isn't going to change. All the Japanese rice traders have done for us is show us exactly what's going on in investor sentiment that is going to occur over and over. Here's that big gap up in Best Buy, a big price move, and then look what's coming off after that. Usually a 45-degree, which is a nice, slow, steady uptrend. And how you determine that it will give you a 10% return. Because if I can see that if I'm buying at 12, what's my 10% minimum return? It needs to get to $13.20, right? $1.20. And if it can go up past that, I want to be in there getting a much bigger return. If I can see that there's a lot of overhead at, let's say, a lot of overhead right here at the resistance level, I might not buy it because I expect to come up here at 8%, start turning around. I'll go find something else. Remember, we're looking at 7,500 trading entities a day. We can scan for the best 2 or 3 trades each day in less than 20 minutes. I can usually do it in less than 5 minutes each day, finding out which is the best signals or the best trades for the next day. Here's a doji. After a strong price move, stochastic's coming up. A perfect candidate for a doji sandwich, which means if it opens positive, you buy it immediately because it's going to have another day just about the same magnitude as that day, number one. Number two, everybody can see there's a resistance level right here. So if it opens positive and starts going through that, what's everybody going to do? They're going to start jumping in because they can see that that resistance level isn't acting as resistance anymore. We're buying immediately because we know exactly what should happen after a positive day after a doji. Bank of America, this one you want to be going short. Notice that when they gapped it up in the overbought condition, that was pretty much the top of the trend. I took profits yesterday, or a couple days ago, on HW because they gapped it up and did at the time was doing a shooting star, and it was coming back down here. Now, I'm not so egotistical to say, all right, they held at the T line, they're still taking it up. I can always buy it back if this is my best buy situation. But if I bought down here and sold up here, I probably got a good profit. Why go after something now that's a high risk when I can find something like this on another chart someplace? ATHN, we've been making very good money on the calls on this one. Very classic. Held the T-line. T-line slow curve, breaks out. Kind of does what we call a scoop pattern, a flat handle, a pullback, goes up through the resistance level, and now pulled back to the T-line, moved up again. We're in a nice steady uptrend. Got some January calls that are going to have to be closed tomorrow, but also have some of the February calls. TTMI. This one you don't really know what to do with, or I wouldn't know what to do with. More than likely what they do on the first go-round is they come back up, test the T-line, fade back off, and then you have to watch for another buy signal. ASML. Nice little gap up into new territory. This one, after a big move like this, you go into a 45 degree, which is usually the same trajectory as the trend before that. When you say opens higher, lower, how long into the open? 5 minutes, 30 minutes? If we think we're in a downtrend or an uptrend, and we still think we're in an uptrend, and tomorrow they open it down, let's say we wake up and the pre-market futures for the Dow are down 25. They open it up and they bring it down 25, but we still think we're in an uptrend. Now we can go to our 5-minute and 10-minute chart and say, all right, are they starting to buy? And if they are, that means that's the initial selling, but we're still in an uptrend. So that might take 5 minutes. That may take 45 minutes. On the other hand, if we think we're in an uptrend and the pre-market futures are saying they're opening 40 points higher, that tells us we're still in an uptrend. I'm going to be buying immediately on any chart that looks attractive. And I'm trying to think of which one that looks attractive. This one, for example. Cup and handle, bouncing up off the 200. If it opens positive, it's breaking out through here. So let's say the market's opening up positive and this is opening up positive. I don't have to wait. I'll buy immediately. Now, on the other hand, if it opens down here and the market's opening up positive, it's not opening in the right direction. So I just put a buy stop, or if I'm sitting here watching it, if they open it lower and then they come up through the close of the previous day, that tells me the bulls are still there. That's where I want to buy, but they just happen to open up a little bit lower. Okay, let's see. Thank you, Gary. Yeah, there's 3 books for sale. They don't have a lot of fluff in it. When somebody shows me a method to make money, I don't want all the funny little stories or all the gibbly glop. I just want you to tell me how to make money with it, and that's pretty much how they're written. Okay, we're gonna see. What about influence of high frequency trading? It doesn't matter to me. That's all built into the candlesticks. That's there. That's the playing field. You don't do anything about that. What was your entry trigger on WH or HW? Probably coming out of this right here where we had a left-right combo. Might not have seen it down here, but notice what it did. It broke this high, pulled back, did a big left-right combo. This is what we call a double doji. Notice they took it up. Stochastics are still heading up, and they did some profit taking. But what type of profit taking do dojis tell us? It's indecisive. It's not going anywhere. So we see a doji, and then they open up positive the next day. What do we know about a doji? They're going to move it in the direction how they open it. And usually after 2 doji day pullbacks, if they open up positive, that means the selling is done. They're going to take it up. So we probably bought right in about here with the idea that if it didn't break through this level, we were back out. So we're in here, closed out up here. That was good enough for me. Do all my trades make money? No. Well, one thing I learned as a stockbroker, even though I thought I was smarter than everybody else, that what I think a stock should do is not necessarily what it's going to do. So I always had a hard time buying a stock, and then as immediately it went down, I kept thinking, all right, everybody that wasn't as smart as me hasn't seen the logic of buying this stock yet, so I'll just wait for it to go back up. And it would keep going down, and finally it hurt so bad I'd sell out, and that would be the bottom. Then on the other side, a lot of people buy a stock and it goes up a little bit, and what's their biggest fear? Boy, would I look stupid if I bought this stock, had a profit, and it went negative, and I didn't take profits. So they sell out very quickly. And so waiting to sell out big time to the downside and selling out quickly on the upside, that's called eating like a bird and pooping like an elephant. And that's what candlestick analysis has alleviated me from doing, is now I'm buying at the bottom. I know when to be out of a trade, and I know when to be in a trade with a much greater degree of accuracy. I need a formula for percentage calculations. Oh, just adding stock. If you buy a stock at 7, it needs to go to 770 to make 10%. So anything above that is above 10%. What's overhead? Oh, I mean, if there's a resistance level? If I'm buying here, where do I think my resistance level is? Right in here. That's where a lot of stock has been trading. I've got to get through that overhead. Do you ever take pivots into consideration? No, but my buddy John Persons is very good using candlesticks and pivot points. Okay, I'm going to have to leave too. Let me go all the way down here. Let's see. Everybody wants to take a look at Apple. Apple has been in a downtrend. And so I tell people, observe the obvious. Every time it's come up near a resistance point, they've sold it back off. They're still selling it off. Right now, they're below the T-line. Even though you had a big up day yesterday, it wasn't a signal. It was just an up day in a downtrend. Can you make money day trading using candlesticks? I made tons of money trading the E-minis off the 1 minute, 3 minute, and 10 minute chart back in my younger days. But then I realized I was trying to squeak out a few hundred extra bucks at the end of the day, and I was leaving hundreds of thousands of hours of portfolios just flopping around out there just because I was trying to make an extra $200 today. Let's see. Do we have a special going on Saturday? Let me get my little calendar out here. What do we got going on? Oh, that's also gaps, so we're doing more gaps. Our next free training will be, I think it's on the 23rd, just an intro to investing using candlesticks, all the advantages there are. And then I think in February, I think it's February 6th, we're doing options, how to use the best option strategies with specific chart patterns. And then on the 19th, free for members also is option spreads, which option spreads to use in particular sessions or in particular times. Yeah, we're doing it with Trading Pub on Saturday. Okay, let's call it a night. Again, anybody new here, we're here every Thursday night, starting at 8 Eastern Time. Fortunately, we've got a very good group on our daily chat sessions that are all interested in helping each other. And the gratifying part to me is that I'm getting through to people. People are emailing me saying they've finally seen a way to make money that they weren't taught before. And my feeling is the way Wall Street teaches people how to make money is not the way for people to make money. It's a good way for Wall Street to make money. But the candlestick signals are merely the graphic depiction of what's going on in investor sentiment. You don't have to use candlesticks per se. If you overlay it on a system that you're already using, but overlay candlesticks on top of it, you're going to be able to see what you're looking at much more clearly.
Above 8 p.m. Do not be sure that Whitem H13.
All right. So with that, we'll see everybody in the chat room tomorrow. Have a good evening.